Hi, everyone, and welcome back to Capital Chronicles. Today, we're diving into Michael Pettis's thought-provoking book, The Great Rebalancing: Trade, Conflict, and the Perilous Road Ahead for the World Economy. This book takes a hard look at how global imbalances in trade, savings, and investment have set the stage for financial crises and even geopolitical tensions, bearing a striking resemblance to the upcoming trade wars. Whether you're a student of economics or just curious about what really drives our global economy, stick around as we unpack Pettis's key arguments and insights. Pettis's central thesis is that the world economy has been running on borrowed time, thanks largely to huge imbalances in trade and capital flows. In simple terms, countries like China, Germany, and Japan have been saving far more than they invest at home. Their excess savings are then exported by buying foreign assets or accumulating foreign exchange reserves. Meanwhile, deficit countries like the United States or many peripheral European nations have been borrowing to finance consumption and investment. He explains that these imbalances are not just quirky numbers on an economic balance sheet. They're the result of policy decisions that shape how much a nation consumes versus how much it saves. When a country's domestic policies, like wage suppression, tax policies, or the structure of its financial system, force households to save more rather than spend, a trade surplus results. Conversely, policies that boost consumption lead to trade deficits. And because every dollar saved has to go somewhere, these imbalances ripple across the globe, tying countries together in surprisingly unstable ways. One of the most interesting parts of the book is how Pettis explains the mechanics behind trade interventions like tariffs, currency policies, and even consumption taxes. He uses a simple hypothetical country, let's call it Fredonia, to illustrate his point. Imagine Fredonia has to import a critical good, say widgets. Now, if the government imposes a tariff on those widgets, the price goes up. Even if the quantity imported doesn't drop, because these widgets are essential, the higher price effectively reduces real household income. What happens next? With less purchasing power, households cut back on other spending. In economic terms, this drop in overall consumption increases the nation's savings rate because production hasn't fallen, but consumption has. And since the trade balance is the gap between domestic savings and investment, even without a drop in the volume of imported widgets, Fredonia's trade deficit shrinks because households are spending less overall. Pettis uses this idea to challenge conventional wisdom. Most people think tariffs work solely by making imported goods more expensive relative to domestic ones. But the real story, he argues, is about how these policies shift the balance between consumption and savings, and thus affect the entire trade balance. The book also explores three major schools of thought when it comes to trade imbalances. First, there's the underconsumption theory. This view holds that when a country's domestic policies suppress consumption by keeping wages low or encouraging high savings, there's simply not enough demand for the goods being produced. The excess goods and capital used to produce them end up being exported to other countries. Next, Pettis discusses the mercantilist argument. Historically, mercantilist policies were about running a surplus to build up reserves, like gold or silver, which was seen as a measure of national strength. Modern versions focus on accumulating foreign exchange reserves, but Pettis argues this explanation falls short, especially for advanced economies that aren't technologically backward yet still run huge surpluses. Lastly, there's the infant industry argument, which suggests some countries use protectionist policies to nurture emerging domestic industries. While this rationale may hold in certain circumstances, Pettis argues it doesn't fully explain the persistent imbalances seen today, particularly in economies like China and Germany, where the surplus isn't about nurturing new industries, but rather the result of policies that deliberately constrain domestic consumption. A significant portion of the book focuses on China's growth model. China's rapid rise has been fueled by an unusual combination: high savings rates and relatively low domestic consumption. Pettis explains that China's policymakers, consciously or not, have steered the economy toward exporting savings. The result? Massive trade surpluses and an accumulation of foreign exchange reserves. But there's a catch. This model, which worked wonders for decades, is becoming increasingly unsustainable. As the economy grows, the pressure to rebalance, shifting from an export-led, investment-heavy model to one driven by domestic consumption, mounts. Pettis warns that if the rebalancing process isn't managed carefully, it could lead to slower growth or even a financial crisis. He also touches on the political dimensions of this rebalancing. For example, President Xi Jinping's consolidation of power has major implications. China's leadership must overcome resistance from entrenched interests that benefited from the old model. The stakes are high, and the transition could be as painful as it is necessary. While China's rebalancing is one dramatic case, Europe presents another, equally complex scenario. Pettis argues that Europe's crisis isn't just about fiscal mismanagement or the technicalities of the euro. It's also deeply connected to global imbalances. Germany, for example, has run persistent surpluses, not simply because of cultural thriftiness, but because its policies have prioritized low wages and restrained domestic consumption. Meanwhile, peripheral European countries have faced chronic underconsumption, leading to high debt levels and policies that only delay inevitable adjustment. Pettis cautions that these imbalances, whether in Europe, the US, or Asia, are unsustainable. Over time, the gap between domestic savings and investment must close. When that adjustment happens, it could be abrupt and painful, potentially triggering financial crises. Another key part of the book deals with capital flows and the role of the US dollar as the global reserve currency. Pettis challenges the common idea that the dollar's dominance is an exorbitant privilege. In reality, the US being the reserve currency comes with significant downsides, especially as other nations accumulate dollar reserves to manage their own imbalances. He warns that unless surplus and deficit countries coordinate policies to rebalance savings and investment, the adjustment process could be abrupt and destabilizing. The Great Rebalancing isn't just an abstract economic concept, it's a real process with profound global consequences. To wrap up, Pettis's key takeaways are: global trade imbalances stem from domestic policy choices, not just market forces. Tariffs and currency policies affect trade balances by shifting consumption and savings. China's export-led growth and Europe's fiscal imbalances are symptoms of a broader global issue. If countries don't adjust, another painful correction, or even crisis, may be on the horizon. Thanks for tuning in to Capital Chronicles. If you enjoyed this deep dive, hit the like button, share your thoughts in the comments, and subscribe for more insights on global finance. See you in the next video.